You're watching the market right here on ET now. Absolutely listless a start to the trading week and a truncated one at that. It was flat as flat can be. I think the markets themselves got the Monday blues. And yeah, this morning the handover is not the best. The Dow is down for a sixth consecutive session. In fact, they opened lower by about 1% pretty much across the board. The Nasdaq as well has managed to underperform. You've seen a huge slide come in stocks, tech stocks that is, like Alphabet, Meta, as well as Nvidia. In fact, they've led the Wall Street decline overnight. The big question is whether or not this is a reversal in the global markets, and is that going to really dampen the question, or rather the sentiment on D Street back home or not?
So Aisha, while there's nothing very scary about yesterday's price action or last week's price action, I would still say that we must also recognize that the summer rally of 2023 for Indian markets was not in isolation. It was also we also got a solid push largely because of what is happening in the global markets. So global markets are reversing and they're threatening to reverse. And that's the setup right now, that how global markets have reversed. So can Indian markets move in isolation? The answer to that looks slightly difficult. I feel that there is a phase in the market when you should go long. There is a phase in the market you should hold, and there is a phase in the market where you should go either short or you should book some profits. I guess we are reaching in that phase of the market where you should now start booking partial profits if your time horizon is 3 to 6 months. Because in the near term, the triggers in the market are not there. Global cues have reversed, expectations from the earnings season are high, IPOs have started, and you are getting a reversal in the FI flows. So I'm not saying that this market is going to slide, but I'm saying that we are in that phase of the market where the upside could be limited and the downside could really be opening up. Just imagine a tree, and in a tree you can shake it. When you shake it, the ripe fruits will fall. And that shakeout could happen because of global cues, it could happen because of macros. But when you're shaking the tree, that does not mean that the tree will get uprooted. And that is what it applies to the market. So the tree here is the India story, and the ripe fruits here are stocks which have appreciated in the last 3 to 6 months. So I think a shakeout, whether it is because of global cues or flows, I think is around the corner, and we are in that phase of the market where it will not hurt you, it will not harm you if you book some profits.
Okay, that's an interesting way to put it in terms of understanding the overall setup and where the Indian markets stand. And speaking of our markets, yesterday 63,000 as a mark on the Sensex. Well, it eluded us. We didn't manage to hold on to that level. We closed on the index, on the Nifty, a tad below the 18,700 mark, and it was the broader markets that really led the way. Pharmaceuticals, auto, that was where the traction was. And in terms of individual stocks, the likes of Reliance Industries, the HDFC twins, TCS, they all led the decline. So Nikunj, as well as the Nifty levels to watch, we'll also be mapping out the trend that we've seen when it comes to FIIs and DIIs, which will be critical.
So you're getting jammed, Awan. Now we may talk about the Sensex having this new all-time high on last week, and Nifty almost there, but you are getting jammed at higher levels. And I continue to maintain that how much can ITC pull up the markets, how much force really some of the auto stocks can generate. Ultimately, you need either a Reliance or an HDFC Bank or Infosys to kick in, and those three heavyweights are just not firing. And that, I think, becomes the restrictive point. So if you're looking at the Nifty, well, the levels and the data points will just come up on your screen in terms of support and resistance. This is what you need to map if you're planning to day trade. I don't think we are looking at a reversal in the Nifty per se. That's the support and that's the resistance. We are going to that resistance again and again, coming back. We are going to the resistance again and again, coming back. So this market is not a short, but in mid and small cap stocks, it will not hurt you. I'll say it again. If you book some profits, imagine a tree, what I said. It could bend, it could shake, and fruits will fall. That does not mean the tree will get uprooted. But they are ripe fruits which I think you need to plug them out and you must cherish them. I think we could really go through that phase of the market. Why? No triggers, FI selling, global cues are reversing.
Okay, and a little bit of easing actually in some of those cream names have actually begun to happen. So if you look at Tata Motors, for instance, that's off about almost 4.5% from its recent highs. Indian Hotels, which has really been the darling of the street for not just, this year, or for that matter, last 2 years, Indian Hotels is down 6% from its recent highs. Even some of these new age tech stocks like a Zomato, like a Paytm, they're down about almost 5 to 6 odd percent from their recent peaks. So yes, that little bit of easing off has begun to happen already. Of course, this week, Nikunj, you've got the IPO street as well, which is a buzz. You've got PKH Ventures, you've got Sign DLM, and of course, Idea Forge as well. So that's going to keep this street busy. But yeah, talking about ITC, that's our exclusive interviews. We've been playing you some of the teaser bites all throughout yesterday and today. It's the mega exclusive with none other than ITC CMD Sanjeev Puri, who says that they will continue to invest to grow, expand and upgrade technology. Also adds that their dividend payouts also very much continue. Here's a slice of that exclusive interaction that Nikunj had with Mr. Puri.
So, Mr. Puri, what we understand is that large part of FMCG capex, the critical capex, is over. The business is now cash generation, which is generating free cash flow. So, can one assume that now you will have more cash in your kitty, so dividend payout ratios will improve? You don't need that much cash because most of your businesses are now self-sustaining.
Already we have a very handsome dividend payment policy.
It can always increase more.
80 to 85%.
Yeah.
I think the balance we certainly need as growth capital because it's not merely capex. It is also, for acquisition. Inorganic growth is another vector that we have identified. So both we have to service. And let me put it this way, that earlier our capex was maybe higher as compared to the size of the business, because we were building the foundation and we were building for scale. Now,
you can actually pick up a biscuit here, and I must say that
we will continue to invest.
I must say some mom's magic, right off the shelf, right?
Yes, absolutely. But let me finish the piece on capex.
Yeah.
I must finish it. See, now we will. It's not that we are not going to invest. We will invest.
Yeah.
But it will be more calibrated and in the context of growth and size. And of course, technology upgradation and so on and so forth. So, at a company level, last year we launched 5 facilities. Construction of 3 more have started this year. 2 are food plants.
So, you already have 11
ICMLs.
Okay.
The 5 is across businesses.
Okay.
So now we have started 2 food facilities and 1 facility for sustainable packaging. So ICMLs, yes, we have 11 of them.
All right, now, in terms of the market setup, let's discuss the technicals. Nuresh is ready. Kunal is running slightly late. It's raining in Bombay, so maybe just one of those early morning traffic snarls. All right, Nuresh, the bulls are looking slightly rusty. The fact that global cues have reversed, how much importance would you pay to that?
So I would say global cues have not reversed in a big way. We've seen a dip across the world as well as in India, a little lesser dip in India comparatively. But overall, we are still in a slow and steady downdrift which happened. So the view is we've not broken any of the important support levels in the global indices or in Indian indices. So till the time we don't break that, the bias should remain positive. The stock specific price action is decent. We are not seeing some cracks in say broader markets or in say certain stocks. So overall the bias is positive. 18,600 remains the crucial point. Only once we start closing below that is the time where we change the view. till that point of time, be stock specific. We are seeing new sectors come up. Yesterday was a day when Nifty Auto Index gave a good close, and it has seen a lot of names in the basket, in the auto basket, showing good momentum. Auto ancillaries have continued to be in a strong uptrend. So autos is one space which has come up in a momentum radar yesterday. So overall, one by one, we are seeing a lot of stocks on radar. The only difference is auto does not have a major weight on the Nifty. It's just the heavyweights which are not pulling up.
I go back to that point again, Naresh, that minus Reliance, minus Reliance, minus HDFC Bank, minus even ICICI Bank now, and Infosys, 4 stocks.
And you have 40% of the index not going anywhere. But the fact is, these names are not falling down also as well. So we are not seeing a sharp crack. So we see this 2450 to 24550 move on Reliance, then it goes back to 2500. You see this move on HDFC Bank going from 1650 to 1580, then back to 1630. So we are not seeing a crack. ICICI Bank broke a 2-week low of 930.35 and could only correct up till 920.25. So what we are seeing is, we are not seeing a crack in the heavyweights. Neither is there momentum in the heavyweights. But when we look at the rest of the weights, there is a lot of momentum. There are a lot of stocks near all-time highs. So you have a L&T closer to an all-time high. You are seeing auto stocks coming closer to an all-time high. And then you have NBFCs, which are some of the smaller names which are at an all-time high. So the case is, 40% of the index is not showing any trend, neither a downtrend or an uptrend, but the rest of the names are continuing to move selectively. So in this condition, we get jammed into a range. So till the time we don't see a range breakout, or at least one of the heavyweights taking a breakout or a breakdown move, we'll stay jammed in this range. But in that period, you can continue to look at broader market stock specific moves. So the view is, till the time we don't change prices below 18,600, and this has been the best way to actually ride the whole move. From 17,000, if you would have kept having this view of till the time we don't take support levels, you would be riding up till now. Otherwise, you would have got, say, at some point of time, you would have said enough is enough.
Right. Okay, let's take it across to Kunal as well, find out what he's making of the market texture this morning. Kunal, hi, morning. Pretty quiet and listless of a Monday. What's in store for us, given that the handover from the globe is a little weak?
Yeah, but I think we are still consolidating. So, 18,600 has been a major support. We've tested the support, I think, over the last 10 days, but we've not broken those levels on the spot basis for the index. And for the Bank Nifty, I think 43,000, 43,500 has been a major support. In fact, it's almost 6 or 7 straight weeks of consolidation for Bank Nifty, where it's been stuck into a 1,000-point band, which is just 2%, 2.2% for a heavyweight index like the banking. So that itself tells you the kind of consolidation we are seeing into one of the major sectors for the index. Now there was one interesting part about the markets yesterday, that we managed to bounce back or protect the 50-day moving average for the Nifty, and that's been characteristic of this trend over the last 2-3 months from the March lows, where the Nifty bottomed out at 16,000 approximately. So from there, we've managed to protect the 50-day moving average, and I think every time we've managed to go into a corrective phase, we've managed to test those levels. The bounce has led to a new high on the index, at least on a swing basis. So we can expect something similar for the index, possibly in the next or the start of the July series. So far, the good part or the differentiating part for the rollovers, for the July series, is the premium for the July futures on the Nifty is at 110 points. So last expiry, we were almost at 80-85 points, which means there is a slight increase in the premium for the index futures. That tells you that maybe the markets are going with a bullish expectation for the July series.
Okay, let's find out what those individual expectations are then in terms of stocks going in with bullish expectations for the next series. So what are your top ideas then, Kunal?
So 2 buy calls. The first one suggesting is a buy in Maruti. The stock made a very good pattern yesterday, bullish engulfing pattern on the daily charts, and a very good recovery for the stock. So would expect the stock to continue to move higher. 10,000 as a target for Maruti, stop loss at 9,200. And the second would be Bandhan Bank. Even this stock showed a bullish hammer pattern yesterday on the candlestick charts, recovered from 235 approximately. So would suggest a buy with a target of 250, stop loss at 233.
Right. Naresh, what about your stock strategies?
So out here looking at more at large caps as such, the first stock would be a buy on Bharti Airtel. The stock has given a breakout about that 840 mark and looks interesting. 840, 850 mark, showing relative resilience for the last 2 sessions. Out here, it's a huge cup and handle formation in the making. 860 has been the high previously. 860 was the high if you remember the MSCI Tech. And in the last two sessions, it has come close to 860. Once it sustains 860, it would confirm a breakout into new all-time highs. A stop loss at 840 and a target price of 920. Second is a buy on Hero MotoCorp. The stock has gone through a long-term phase of zero returns. The stock is available at the same prices where it was 8, 9, 10 years back. Now, technically, the stock started giving the first indications of a breakout by crossing 2900. Saw a dip recently on the some news announcement, and now started making a recovery in the last three sessions. Sustaining this move about 2850 is the first indication of a reversal in place. I would expect eventually to break 2950, 3000 levels also and go towards 3300 plus. So a good entry point right now. Stop loss at 2770, a target price of 3300 to start with.
Let's spend some time discussing Hero MotoCorp. And the entire two-wheeler space now is going through interesting phase. There is going to be intense competition, which iShares will for the first time will have to face, because you've got Hero MotoCorp, which is coming with a high-end bike. When I say high-end bike, superior high-end CC bike in collaboration with Harley Davidson. Bajaj is looking at launching Triumph. Now, iShares' monopoly in the entire premium segment, which is where they have a dominant market share, more than 75-80% market share, up until now has not been challenged. Now, historically, we've seen that when there are new launches, those new launches always tend to have an impact on the stock. So, for example, XUV launches, 2021 and 2022 for Mahindra and Mahindra did the trick. Then they had Thar. Right now, everybody is talking about Maruti because of the Jimny launch, and Maruti has started outperforming. Will there be a trade? Will there be a turn in the fortunes of iShares given that competition has intensified? Hero MotoCorp as a stock has done nothing. For Bajaj Auto, Nigeria is coming back, and the domestic market has also stabilized. So, Naresh, could it be short iShares, short TVS, but long Hero MotoCorp, like you said, along with Bajaj Auto? Could that be a positional trade, not just a day trade?
So it's a tough one to be looking at iShares Motors as a short, but maybe TVS Motors as a short because the stock has outperformed in a major way. And going forward, Hero MotoCorp could outperform similarly, or at least say outperform TVS Motors. So overall, that's a trade which can be possible: long Hero MotoCorp, short TVS Motors. But a simpler trade is to just go long on Hero MotoCorp, which has gone through a 8 to 10 year period of zero returns. And this is what has happened in the auto segment. We go through these phases. There was a time iShares Motors became the talk of the town, the best quality stock. And from 2015 for the next 5-7 years, the returns were zero. Same way, Maruti became talk of the town, went to 10,000, and then nothing has happened for the next 5 years. TVS Motors also saw a change after being nowhere for multiple years. Mahindra and Mahindra. So that has generally been the trend in auto names. They go through a phase of huge returns, then go hibernate for 5-7 years, 8 years, and then again start up a move. Hero MotoCorp fits exactly into that place where Mahindra and Mahindra or maybe TVS was. And at these prices, when the returns have been bad for the last 8-10 years, the risk reward is in favor. And even from the lows, it has not moved up quite a bit. So I would go with Hero MotoCorp long. And if one has to take an extra trade, it would be short TVS Motors.
Okay, that's the view coming in on some of those auto stocks which are in the spotlight. But another stock that will, of course, be in the news is going to be HUL. Sanjeev Mehta resigning after 10 years being at the helm. And you have Rohit Java, who's now going to take over as the MD and CEO effective today. And it's interesting because, Nikunj, we've seen an annualized return in HUL of about 18%. And compared to its peers, it has managed to stand out with the peer return being about 10%.
His tenure, I think, has really been one of the most difficult tenure any HUL chairman has had. And I'll tell you why. Because when he took over as the head of the India business, there was this disruptive brand called Patanjali. And Patanjali had knocked off the bottoms for a lot of FMG companies. They were selling with the promise of reach, cheap, and Ayurveda. And that, in a sense, was really having an impact on the traditional FMCG companies, especially in the case of food. And then, in middle of his tenure, he went and acquired Horlicks. Now, we can argue whether Horlicks is doing well or not, But the fact that they use share swap to acquire the malt business, he's done so he's able to protect his turf and he's able to increase the turf by acquiring the brand Horlicks. What I like about Sanjeev Mehta's tenure was that during that period, HUL migrated into a different company in terms of margins. And the phrase again I would like to use for HUL here is that who says elephants cannot dance? I mean the margins which were below 20% now are permanently above 20 for a business which was very competitive and for a stock which was considered to be expensive, I think has given great returns. So I think his tenure will be marked as a tenure where if Mr. Dadi Seth took HUL big in terms of reach, if Mr. Banga got things in terms of technology and in terms of cost efficiencies, I guess Sanjeev Mehta was able to stand tall. He was able to fight the competition, increase margins and acquire a company. It's not been easy for the FMCG business per se. Just think about it, how many brands are getting created, how many new online brands are getting created, your supply chains are getting disrupted because of Amazon, big basket, everything is disruptive. And then HUL has given great returns. So I mean, really kudos to him that what he's managed to achieve.
Yeah, absolutely. The other stock, of course, in focus is also going to be Bajaj Auto. They're looking at the UK launch of Bajaj Triumph bikes, and this is sort of treading the path of Royal Enfield. Let's see what magic can Bajaj Auto create.
Aisha, for Bajaj Auto, this is not bread and butter.
Yeah.
For Royal Enfield, for Aisha, Royal Enfield is bread and butter. If anything happens to their dominant market share, I mean, they could be in trouble. Up until now, people have tried and companies have tried. They've not been able to dent their dominance there. If Bajaj and now Hero MotoCorp, if they're able to, let's say, take a slice out, 5%, 10% market share, then the supremacy of Eicher gets challenged. See, what is Eicher? Eicher is not Sasta Sundar Tikau bike segment. Eicher is a promise of an experience. It's not an ordinary mode of transport. It is an experiential biking segment which they represent. They charge higher margins, they command better pricing, and it's a cohort or perhaps it's a community which RE is able to dominate. And that is giving Eicher a premium positioning. And if that gets challenged, which will not happen overnight, I think the stock premium could dilute. In the past also, everybody tried to take their market share away. They failed. But this time, I guess the competition is real. Largely what Bajaj is trying to do, they're trying to scale up Triumph, and what Honda is trying to do, or what what Hero is trying to do with their new offering where they've got Harley Davidson as a technology partner. So it would be a very interesting space now to watch out for, because this is one space which will get only challenged. I mean, you remember what happened in the passenger car segment a couple of years ago. Maruti had a dominant market share, then everybody came in and nobody was able to defeat Maruti. What happened? The existing, let's say it was Ford or Chevrolet, everybody came to India. They were not able to eat into Maruti's market share. Maruti didn't have any impact, but they had to shut down their business. Ford had to sell out, Chevrolet had to sell out. I think GM never was able to accelerate. There's a time when there were 12 car companies in India. Today, not even 6. So I'm not sure if Eicher's dominant market share will get hit, but the race would be a fight, I think, for next 6 months would be an interesting one. That's my sense.
Okay, indeed, it is going to be an interesting one. So lots of stocks there that we will be putting the spotlight on. But in terms of as well what we'll be monitoring by way of those brokerage notes, we'll be watching out for fresh brokerage calls as well this morning. You've got something like an IndusInd Bank that's going to be in the spotlight. You've got Macquarie, which has maintained their outperform rating with a target price of about 15.10, and Macquarie has come out with their report on banks as well as on Paytm, where they've downgraded the stock to neutral owing to a sharp run up in the share price. So these are some of the other names that we will be tracking. But let's also listen in to what Gautam Trivedi has to say, as he's betting on the consumption space. He likes the stocks like Landmark Cars and Sapphire Foods. Listen in.
We don't own Indian Hotels. That's the one we missed, and we feel bad about it. But Landmark Cars, I think, is a great example of being a classic urban play. We also own Sapphire Foods as another urban play. And I tell our investors that we really are seeing signs of two Indias. One, of course, being urban India, the other being the tier 3, tier 4, and the rest of India. And the fact is that you're still not seeing any significant slowdown in urban India. If you look at air traffic, if you look at the hotel industry, if you look at premium and luxury car sales. So that continues at a very strong pace. There might be a bit of a slowdown, but I still don't see any significant slowdown happening. So we're playing that through the urban consumption themes like a Landmark or a Sapphire Foods. I think the one that we do own, which is Infosys, has been the worst hit of the IT pack, and given valuations today where it is, maybe it's worth buying some. I don't know the answer, frankly. We're a little lost in the IT space. Specific to Reliance, I think there's a lot of value unlocking that's still to happen, whether it is Geo Financial Services or Geo Platforms itself, whenever that ends up having a mega IPO. So I think that stock is clearly undervalued. It's been one of my favorite long-only plays in this market.
Welcome back. Still tuned into the market. We've got a weak handover from the US, the Asian markets as well, looking a bit mixed. And we'll be tracking, of course, whether or not we are able to sustain around the 18,700 mark in today's trading session. Do remember, it is expiry week. That's the SGX Nifty pointing towards 18,700 plus print. But yesterday, we wrapped up the day around 18,691 with the broader markets shining. Lots of stocks in news today, including the FMCG space, and they've really been chomping on decent gains of late because you've seen easing raw material prices that could potentially aid their margin growth in the coming quarters. Which segments could likely benefit the most and which could continue to lag? We've got Vinny, who tracks the sector closely and joins in with the details. Vinny?
Talking about the FMCG companies, let's not forget earnings season is just around the corner, and how raw material prices move impacts the margins of the company. Obviously, most of the companies have taken in terms of a cost control measure already coming in. Now, look at the trends that we're seeing coming in terms of the pricing. When you look at the palm oil prices, they have seen a decline of 40% on a year-on-year basis, while on a quarter-on-quarter basis, also we're seeing a correction coming in. Other than that, copra prices that have seen a correction year-on-year basis as well as on a quarter-on-quarter basis as well. We've seen wheat prices correct on a quarter-on-quarter basis, but still wheat prices a bit on the higher end when you look at it on a year-on-year basis. Quarter-on-quarter basis, yes, a correction that has come in terms of the wheat prices. Now, sugar prices and wheat prices, when you look at it both on a year-on-year basis, we are seeing an increase, while even for sugar on a quarter-on-quarter, we are seeing an increase coming in as well. And lastly, PFD, yes, PFAD, that on a year-on-year basis has seen a decline, but on a quarter-on-quarter basis, when you look at it, there's an uptick coming in there. So now, which companies get impacted by this? When you talk about palm oil prices, mainly is used in soaps as well as in biscuits as well. You use a bit of palm oil prices as well. So yes, this is the breakup of raw material costs. So obviously, in terms of GCPL for soaps that they're making, GCPL 20% of the cost of raw material is about palm oil. HUL 25% is palm oil cost, that is in the raw material cost. Nestle 10% and Britannia 15%. So obviously, palm oil prices correcting does benefit these companies. So yes, keeping an eye out on these FMCG companies. Let's move on and talk about some of the companies that are impacted in terms of the discretionary side. That's your paint segment. So you have crude prices, TiO2 prices, VAM and HPDE prices. That's the packing prices. When these start seeing a correction coming in, they support the paint companies and the paint margins as well. Now, when you look at it in the terms of trends coming in here, both on a year-on-year basis and quarter-on-quarter basis, also we are seeing a decline in these prices. So that is surely going to be supporting the margins for paint companies. Whether you look at it in terms of Asian Paints, Pidilite, all this does start benefiting the companies as well. Other than that, rural recovery, that's an important factor that we should keep an eye out on as well, because that is something that will impact it in terms of the companies as well. And for Marico, margins are expected to remain flattish because not much of the basket comes from these products and these commodities. Other than that, in terms of sugar, wheat and tea, keep an eye out on that, because if that sees an increase, there is an increase that comes in the basket for biscuit makers. For tea prices, obviously keeping an eye out on Tata Consumers, because tea prices increases impacts the margins over there as well. But yes, most of them have seen a correction and expect an improvement in terms of margins for the company.
Okay, Vinay, we'll leave it at that. Let's shift focus now to the private lender, IndusInd Bank. That's going to be in focus in the back of this bullish Macquarie note. What does the note read? Harsh is here with the details.
Well, yes, Macquarie met up with IndusInd Bank, and IndusInd Bank has guided for a 2% ROA over the longer term. That's the target, that's the guidance. Where will this 2% ROA come from? They're expecting NIMs to go up from that 4.25% mark all the way to 4.4% over the medium term. This 15 bips of NIMs will largely be pushed by lower deposit costs. So that's one piece of it. The other piece of it, of course, is solid loan growth. IndusInd Bank has guided for 18 to 23% loan growth over the next 3 years or thereabouts, and they are expecting to clock that on the back of stronger deposit growth. So they believe that loan growth will follow deposit growth going forward. Also, what they're suggesting is credit costs will be benign. 1.1 to 1.3% is where credit costs will be at. That's what they're guiding for, versus the 1.5% plus credit costs in FY23 full year. So they're expecting credit costs to start to come off. They're also expecting to consolidate the balance sheet better, which is to suggest that where MFI lending is concerned, they want to build up more buffers, more contingent provisions, and that's what will, really drive momentum with regard to where the balance sheet and the consolidation of the balance sheet is concerned, and drive momentum for loan growth and confidence for the bank, and therefore lead to a 2% ROA consistent over the longer term. That's what Macquarie concludes, and what Macquarie does believe is IndusInd Bank is an outperform, trading at 40% discount to its peers. They've kept a target price of $1,510 a share, and they believe two things will drive the re-rating. One is the fact that the Hindujars will increase their stake from 15% to 26%, and two is, of course, the ROA is reaching that critical 2% mark.
All right, that's a stock that we'll be keeping on our radar in trade today. Thanks very much, Harsh, for those details. But top fundamental stock ideas through the show. Let's hear it out from Amnish Agarwal. He's bullish on capital goods.
Couple of years kind of, I think, horizon. One space we have been very optimistic about is capital goods. And I think among the frontline capital goods companies, I think the twin pack of ABB and Siemens, I think both the companies are doing quite well. So they are in the center of whether it is, you can say, energy transition, digitizations, data centers. So this entire space looks very interesting, but particularly I think over the next couple of years, Siemens and ABB, both these stocks looks very interesting to us.
Okay, let me welcome on board then Rahul Shah from Motilal Oswal Financial Services and find out what he's making of the market right now. Rahul, hi, good morning. Good to have you on the show. Rahul, we seem to get a little sideways and we've been consolidating for a while now. Given that global markets are also slowly somewhat easing off, do you think for someone who has a 3 to 6 month perspective or time frame in the market, they should be looking at least partial profit taking?
Hi, good morning. I think one we should not forget, yes, that last couple of weeks, I think we've been seeing that the markets are in a sideways momentum, but the FI's flow has also been a very good. And interestingly to note that I think in a week we have 2-3 blocks which are coming up, which and they have been successfully raised by the promoters or by the private equity guys or whoever the seller is in that perspective, and we've seen a good decent momentum building it on that side. Secondly, I think IPO markets, if we look at, have just started building up. So I think the fundraising part is doing quite well, and then if we look at the FI's inflow in last 1.5 months has been quite good, and I think this trend is evident. Secondly, I think if we look at the post the result season, I think somewhere down the line, I think we have seen a good rally, but then that just consolidating. So I feel that I think now what the market is doing is, I think the select pockets will continue to do well. Broader base, if I talk about the next perspective, might take a breather or maybe on a sideways momentum before again the Q1 number starts coming up after, in the next couple of weeks from here onwards or so. So my sense is, I think overall trend looks positive. Needs to be very get into a stocks where there's a valuation comfort or where there's a growth which is obviously, and the management commentary is very strong, and there's a visibility of earnings. I think all these three factors needs to be taken care of, and I think looks like that markets will be more of a stock specific from here.
Right, okay. The IPO market as well is a flush. In fact, you've got Idea Forge. The IPO's day one is done, and it's been oversubscribed on day one itself. Looking at what the retail response has been, it's been a 12.5 times subscription that you've seen. Employees, of course, 8.5, and you've got the DIIs as well clocking in about almost over 7 times, and that's a total subscription of 3.7 times. that we're looking at. In fact, talking about the IPO market, there's more primary action. They signed DLM as well, which is going to be open for subscription today. Let me take it across to Somit, my colleague, and find out more about this one.
Well, Cyan DLM IPO, which opens on June 27th, will remain open till June 30th, and the price band for this IPO is 250 to 265. Now, the entire issue size is a fresh issue, where the company is looking to raise close to 592 crore rupees, and because of this, the promoter holding will come down to 66.7%, which is below the minimum promoter requirement of SEBI. Now, they are raising the funds for working capital purpose. Nearly 290 crore will be used for that. 160 odd crore will be used for debt repayment. 70 crore will be kept aside for acquisitions, while 44 crore will be used by the company for capital expenditure purpose. Now, it is a EMS, that is Electronic Manufacturing Service and Solution Provider company. It mainly generates its revenue by selling circuit boards and cable harnesses. Now, it segment wise, if you see, defense segment contributes the most to its revenue, around 38%, followed by industrials and aerospace. Now, its financials over FY20 to FY23, the company's revenues have increased at a CAGR of around 16.6%, while the company has also turned a net profit in FY23 from loss in FY20. Also, the company's leverage have come down to around 1.7x net debt to EBITDA, which would further fall on the back of the fundraise that the company is doing. On the valuation front, if you see, if you assume a 15% revenue growth and the peak net margin of around 5.5%, the company could generate a profit of close to 53 crore, which means that its 12-month forward price to earnings stands at close to 39.6 times. Now, its closest peer are Keynes and Syrma SGS. Now, comparing the valuations of Syrma and Keynes, the valuations of Cyan DLM is on the cheaper side, but when we compare it with other EMS players like Amber and Avalon, the company's valuations are a bit on the expensive side, that is at 39.6x. That is a 12-month forward valuation.
Thanks very much, Somesh, for giving us all of those details. IPOs are going to be critical this week, but what will also be critical are the stocks on the editor's radar. So let's get cracking then. We've got Star Health and Paytm that we'll be discussing, both brokerage candidates. Let's begin with Paytm and talk about the latest note that's coming from Macquarie. They've downgraded the stock to the neutral rating, and they've also slashed the target price. They've attributed it to the run-up in the share price and competition now from Jio Financial.
Let's first look at Paytm and Nifty. It's not a like-to-like comparison, but we're trying to establish that how unreal the outperformance in some of the consumer and fintech stocks is. Selective data, but we're looking at the year-to-date change in, let's say, the Nifty and the Paytm stock. Now that's yesterday's Paytm stock. Let's look at the year-to-date move here, and that will just come up, and there you go. Now, Paytm is up 57%, and Nifty this year is up 3%. 57%, 3%. So the rise in Paytm, I guess, has been
from those lows.
From those lows. Bombed out levels, I completely agree. Yeah. But the underperformance in Paytm, or the deep value which had come in Paytm, the contra buyers, I think they've really got what they wanted in terms of a comeback. Now for Paytm, there are two concerns here. I'm not even getting into business, but Jio, Reliance AGM. And ahead of Reliance AGM this time, it may not be green hydrogen, it may be about the new kid on the block, which they would be listing somewhere in FY24, which is Reliance Financial Services. Markets are expecting Reliance or Mukesh Ambani to come out and make some grand announcements about how large they will scale up their financial services. Directly, indirectly, it's going to be a digital-based service, which could have impact on Paytm and the entire fintech space per se. That is something which you need to be aware of. Yeah. Second, bank investors are not done selling. Especially we know that Alibaba still has with 25% stake. Higher the stock price goes, the more chances of them selling. I think it's going to be something which could change the demand-supply dynamics. So the stock is no longer bombed out. The valuations are no longer all that attractive. Real concern which could come out of from Reliance AGM in terms of what the Reliance vision for financial services could be and the overhang of the stock. Net, I think it may not hurt you if you own Paytm to book some profits. And I think in the near term, the stock may just get jammed, largely because some of the concerns I flagged off.
Okay, so those are the concerns, may not hurt to book profits in Paytm. Let's move right on to Star Health then. It's a positive brokerage note from CLSA. They've maintained a buy rating with a target price of 700. And Nikuj, they've listed out a number of drivers in their overall business that can aid this growth.
This entire space has gone through a rough and a tough patch, and that's largely because of the claims they had to give because of COVID. It's in the healthcare business, COVID claims, hospitalization are very high. As a result, this entire space, they had to go through what could be called as a tough period. For Star Health, They've understood that running the corporate business in India is going to be difficult, and they're looking at exiting that business. They are focusing on the retail business. They've got a lot of levers here. The banca and the semi-urban rural market, largely retail. That's work in progress, and that I think what market should recognize. For a minute, let's keep away the whole halo effect that at once upon a time Rakesh Jhunwala invested in it, and Rare still has a large chunky stake there. But if you look at the business independently, the stock has done nothing. This entire insurance space is making a comeback. This is one of the finest company in the healthcare business, and valuations are looking attractive. I will not be surprised that from here next 6 months, a company like Star Health could actually start outperforming the market. Just like Paytm and FinTech outperformed in the first half of this year, some of the insurance and some of the AMCs and some of the other allied companies may outperform in the second half of this year.
And here are some of the growth drivers according to CLSA. Okay, hope you took note of these stocks on the editor's radar, and it would be interesting, Aisha, as well, to get in our guest perspective.
Well, yeah, absolutely. In fact, let me get on board, Rahul, to talk about this. Rahul, do you feel that, Paytm, while year-to-date it may be up 57%, from the 52-week lows, it's gained about almost 90%, but off late it's eased off about 4 to 5%. What do you do with the stock right now? Profit take further or buy the decline already?
I think if you notice, I think after a spectacular crash, if we talk about it in all these new age businesses, then at some point of time there was a value in most of the stocks. If we talk about Paytm, Policybazaar, Nykaa, Zomato, all of them at some point of time became attractive, and they have done well. So I think talking about Paytm, I think post their quarterly earnings and then the kind of the guidance what they have given and turning into an EBITDA positive, I think the kind of businesses what they are into and increase into the use of the merchants. I feel that Paytm could be, I think the stock has already done pointed out, I think 50% from the lows, and I think we also had come out with a report and it's up 40-45% from there. So I think the stock immediate, I think looks, limited upside in near term in next 3-4 months or 6 months if we talk about. But in any correction, one should definitely look at stock like Paytm. And then if you have a view for next 3-5 years, then definitely then it is another story in the stock, and I think we can look at it and there could be a good upside for it. But near term, I think the stock has done the major upside has been capped from here. That is what it looks like in Paytm.
What about Star Health? Would you agree with our analysis that this really could be one of those contra calls where after months and months of underperformance, it could outperform now, given that they're looking at changing their business mix?
So, Nikunj, I feel that entire Star Health, if you talk about entire insurance space, has done nothing if you look at it last year and a half. And I think this remains one of the top preferred pick in our portfolio as well. And we feel that I think the kind of businesses, kind of the growth which they can get. And this quarterly numbers were also pretty strong, what our analyst was estimating. So I feel that if you have a little bit of longer term horizon from here, even in the next 6 months or later, I think definitely this stock should do well. So I feel that risk versus reward will definitely pay off in this company. So I think we'll be a buyer in Star Health at this current prices.
Look out for Parag Milk as well. That's going to be an interesting stock to look out for. Sixth Sense, led by Nikhil Vora, has bought about almost 8 lakh shares at a price value of 132 rupees per share via a block. So this is going to be an interesting one to look out for. And AB Capital, we at ET now got it right. They've launched the QIP to raise about 1,750 crore rupees. The floor price being set at 175 thereabouts. So that's another stock that we're going to be looking out for. But Kunal, 2 stocks for you, Paytm as well as Parag Milk.
So Paytm, I would still be bullish on the stock now. What has actually happened is many of these new age names, they've rallied up significantly higher. I think as Nikunj was alluding, 57% higher for Paytm on a YTD basis. And after such a kind of a steep rally, these stocks are bound to get into a 10-15% kind of a correction. But the only point is that whether these are trend changing corrections for these stocks or whether these are corrections which are part and parcel for every trend for the stock price. I would probably expect that it's latter, and it's probably the stock which has gone into a bit of an overbought nature or a big divergence from its long-term averages could now probably get into a mean reversion phase. But I think buying on dips could be a good strategy back again for Paytm. Parag Milk, on the other hand, the stock has recovered very smartly from the lows of 70, 60, 65 or 70 in the month of March. It's almost doubled from those levels. Very strong volumes in the last 4-5 months for Parag Milk. So that itself tells you the kind of recovery the stock has shown. In fact, it's also formed a double bottom on the weekly as well as on the monthly charts for itself. So which means that this could be a strong breakout for Parag Milk, and possibly this this technical move could extend itself towards 175 to 180. So a decent upside of almost 30% further from current levels could be seen in Parag Milk, possibly in the next 6 months plus.
Milk as a category perhaps is bigger than wheat and rice. And Amul has such a large dominant market share. And unfortunately, if you look at the old milk companies, they've run into their own unique set of problems. Heritage Foods, it was like the go-go stock at once upon a time. Parag, when it listed, it was really the go-go stock. But look at some of these stocks. Because of compulsions, because of the political, issues, supply chain, mismanagement, none of the so-called pure milk companies in India have really hit out of the park. The only exception there is Amul, which unfortunately is not listed. But you got Britannia, which is I think done well, but Britannia is more like a dairy company, but then they are getting a large part of their revenue from cheese and from biscuits and from everything else. Rahul, we've got the ITC chairman on the channel today, and ITC has been one of the best performing stocks. For a stock which nobody liked 2 years ago because of ESG, tobacco, cigarettes, now is the toast of the town. So what has changed? They still sell cigarettes, they are still in tobacco business, but nobody's talking about it.
I think Nikunj, at some price and some valuation, if you look at it, then things looks attractive. The same thing has happened with ITC, and if you look at it, I think last year and a half, the stock has been an outperformer. In earlier 3-4 years, I think this was a stock which has been laggard during the COVID time. Also post-COVID, we saw a smart rally in most of the companies, and I think this remained a laggards in that perspective. So I think 2-3 things changes which we can talk about. One is obviously that cigarette business has been still one of the the major revenue contributor in that space, and I think which will continue. Looks like we have seen the quarterly numbers and which they have come up with. Secondly, I think the other businesses, I think that perspective have changed, and I think that's what the market is looking at it. If you look at hotels, if you look at FMCG business, or so on and on. So all other businesses put together, though the revenue contribution to the overall balance sheet might be lesser than what the cigarette business still, which is what they are contributing. But I think this perspective about overall full-fledged FMCG company, that is what the markets have started looking at. And I think the valuation which it used to trade, I think people have started giving evaluations to this company. And then most importantly, I think if we look at it, other consumer companies and the valuation which they are trading, I think still if I look at it, if I have to compare it, then I think still at a discount. So I think this is one of the this few reasons which I feel that I think what has changed for the perspective of the market on the ITC.
Right. Okay. Well, let's talk about one trigger which definitely the markets do take very seriously. So let's get a check on what the rain gods are indicating. Maharashtra seems to be fully covered, but let me take it across to Aishwarya, get the monsoon update for the entire country. Aishwarya?
Hi, good morning. So it's the 27th of June, and we'll see what kind of rainfall India has recorded until the 26th of June, which is yesterday. Overall, the country is still lagging behind, 23% shortfall in rainfall as compared to the yearly average. But let's take a look at each of these regions specifically. East and the northeast of India are seeing a shortfall of 23%. Northwest of India is in the green, which is seeing a positive of 46%. So they are in the surplus of 46% and improving day by day. As compared to Northwest India, Central India and Southern Peninsular India are also lagging behind at 35% and 46% of shortfall overall in the rainfall. Let's move on and talk about which regions will see variable intensity of rainfall. Well, Vidarbha and MP are the regions which will see heavy, very heavy or extremely heavy rainfall, depending on the pockets which has lower pressure. The other regions which will see heavy rainfall includes Himachal Pradesh, the northeastern part, all the Seven Sisters. And if you see the chart right now, most of India has been covered. 90% of it has been covered. So the southwestern monsoon has covered most of the country. Thunderstorm and lightning, a huge cloud cover will be seen, which means more intensity in these regions, including Madhya Pradesh, Vidarbha, Chhattisgarh, northeastern of India. Now, these are actually sort of colliding with the heavy and very heavy rainfall regions, but these regions will see some sort of intensity. And when we talk about squally winds, west and southwestern region, adjoining part of Central Arabian Sea, as well as the Gulf of Mannar, these are the regions which will see 65 kmph to 40 kmph of winds in these regions. Now, let's move on and talk about which are the regions which will see widespread rainfall. Uttarakhand, Himachal Pradesh, Konkan as well as Goa region, and coastal Karnataka. This, for the rest of the week, will see widespread rainfall throughout the state. And other subdivisions include which are isolated pockets in these states.
Right, Aishwarya. Thank you. Thank you for that update. So from a market standpoint, really, the concerns I think right now are behind us. They've been, allied, so to speak, that, monsoon is going to be late, it's going to have impact on the crop, it's going to have impact on the recovery. Yes, mathematically, right now, if you look at the numbers will prove that we are below the long-term averages because monsoon progress actually has been late in Western India. But in Mumbai and in Delhi, I think for the first time after nearly 50-55 years, the monsoon has arrived on the same time. So North India is not suffering, it's only parts of Western India where the rainfall this year actually started low. Rahul, this was a niggling concern for the market. Is this concern now addressed, that monsoon worries are behind us?
I think, as you rightly pointed, Nikunj, I think if we start at 10 days back, if you would have spoken this, then I think obviously monsoon would have been a concern for the markets and what we read the headline and what the weather department used to talk about. So I think more or less this is sorted for at least for a while, and I think as we see the updates coming up with the deficits running in Maharashtra and Mumbai and so on, the couple of days. So I think obviously, I think near term looks like another next couple of weeks to closely watch on the updates of the monsoon is spread through across the country, which will give a positive perspective. But I think looking at it, way it has started in few pockets, I think looks like that. I think we don't see the kind of fear which was there in before 15 days or so.
One stock which has done very, very, very well, and I'm going to discuss it first with Rahul, then with Kunal, and then with Naresh, and that stock is Trent. Now, with any yardstick, Rahul, whether it's P multiple or based on the market cap, the stock is wildly expensive. It is up 30% this year, and the COVID low was some 500, and from 500 it's become 1700. What has done the trick for Trent?
So I think we've not been covering stock of Trent at this level, but I think what we feel is I think the valuations, as you rightly pointed out, is very expensive. And I think the way if we look at 2-3 things positive side of it in the entire space, and if we look at it, the entire if you look at the entire sector, this has outperformed vis-a-vis all other stocks. So I think 2-3 things. Obviously, the launch of the stores, what they're talking about, the differentiation between a brand called Studio and so on and on. So I think these two are differentiated, but I think at these valuations, we are not comfortable in advising buying a Trent at this current price.
Okay, the one space which has been a buzz is definitely pharmaceuticals, and that was the case yesterday as well. Be it a Sun Pharma, which is going to be active today. They've got Health Canada nod coming in for one of their acne drugs. Not just Sun Pharma, but just look at some of the movers yesterday, and not just pharmaceuticals, but the entire healthcare space. So be it a Cipla, which held out well, a Divi's, which did quite okay. There was, of course, Metropolis and Laurus Labs as well, which were big buzzers in trade yesterday. Naresh, anything that's tradable within the pharma or the larger healthcare pack today?
So in the pharma names, there's clearly Dr. Reddy's, which has shown a lot of resilience. So the stock gave a breakout earlier about 4,400, 4,500, went up to 4,950, saw a gap down, and is now back above those levels. So when a stock crosses back such a big gap down, That's generally a counter indication of a strength. So out here, the fastest recovery. Otherwise, in the previous falls, we've seen pharma names once they take a gap down. There are multiple gap downs rather than a recovery. So Dr. Reddy's is the large cap pharma pack name, which has given a clean breakout above the 5,000 mark. So this could very well head up to 5,500. Would keep a stop loss below 4,900. And the other one is to actually look at Sun Pharma or look at Spark, which is Sun Pharma Advanced Research, an indirect play on Sun Pharma, which saw a very large volume tick yesterday, almost a 5x to 10x volume tick. So Sun Pharma and Sun Pharma Advanced Research also look interesting. Sun Pharma sustaining 1,020 would indicate a short-term breakout. That's the high for the last 2 weeks as well as the last 3 months. So on radar are the two largest names in the pharma index itself, which could be interesting going forward.
Okay, that is interesting indeed. But the other interesting big talking point on our channel is the interview with the management of ITC. The stock, incidentally, has seen a stellar run up over the past few years. The share price has nearly doubled. But does the chairman managing director, Sanjeev Puri, track ITC's stock? Let's listen in.
Did you get excited when the stock crossed 400 rupees and made a new high?
Well, it is always nice to hear that, because ultimately it makes all stakeholders happy, it makes shareholders happy. But always we must come back and understand that the role of management, and this is something that it is so irrespective of where the stock price is, the role of the management is to put our heads down, roll up our sleeves, to build competitiveness, think about the business tomorrow and day after, and of course the here and now and today. Make sure we deliver competitively superior value, and we leave the market to determine the valuations. So yes, it feels nice, but the task for us continues to be the same, continues to be building businesses, getting them to the next level of growth and the next level of performance.
The industry leading growth is incremental. The capacity you're building is telling me that you're preparing for exponential growth.
While we create the civil infrastructure, the line addition is in consonance with the market growth. Because in a food factory, it's not a smart idea to keep on constructing.
Right.
Hygiene and hygiene standards have to be very, very strict here. So if we are to, scale up beyond what we have constructed, it will be a completely isolated construction. Adjacent, but isolated, right?
Okay, getting set then for trade this Tuesday morning. Rahul, great to have you on the show. We'll let you go on that note. Let's talk about some mid-cap strategies as well. Naresh, come to you. What's on your mid-cap radar?
So that would be a buy on Tata Chemicals. The stock has been around that 980 to 1020 mark for the last few days. 1000 to 1020 is the breakout point. We saw a flip back a few days back, but we've again seen a reversal yesterday. Getting close to that breakout point, once it crosses that 1000, 1020 mark, it could be a quick move to 1100, 1200 levels. So preemptive buy here with a stop loss at 970 and a target price of 1100.
Right. Kunal, what about your mid-cap strategies?
That'll be a buy on Godrej Properties. The stock yesterday bounced back from its 50 moving average after a mild correction of 5%. Sub the 1500 mark. It's made a good comeback. So expecting this comeback to last for at least another 50 to 70 rupees on the upside. 1580 is the revised target for Godrej Properties and stop loss at 1510.
All right, there you have it. Those are some interesting top recommendations from our charters, the mid-cap calls. But let's move on then. Here are some of the other top headlines to track, and it's good news for working professionals. The deadline for higher EPS pension has been extended to the 11th of July. The application form needs to be submitted within 15 days to get a pension on higher wages. Now, according to the EPFO press release, 3 months have been given to employers for uploading their wage details online. Meantime, shortage woes for the bright red tomatoes have led to lofty prices. They're now dearer and they've shot up beyond the 100 rupee mark. Tomato prices are now 80 to 120 rupees per kg in retail markets. Wholesale prices anywhere between 65 to 70 rupees a kg. The sweltering temperatures and lower production along with delayed monsoon are only some of the reasons which are responsible. And the central bank tightening has seen no bounds, with Pakistan's central bank joining the bandwagon of many banks hiking rates in a bid to tackle inflation. The bank has raised the benchmark policy rate by 100 basis points to 22% in an emergency meeting. The move comes a day after the country revised its budget for the fiscal year from July 1st in a bid to rescue an IMF program that expires in days.
And consulting giant KPMG will be laying off as much as 5% of its US workforce amid economic headwinds and historically low attrition rates. Remember, the firm had cut around 2% of its US workforce back in February, making it among the first few firms to slash jobs in the country. The latest job cuts will take place through the rest of 2023. And some good news coming in. Diwali is going to be Diwali is all set to become a school holiday in New York City. Mayor Eric Adams calls this decision as a significant win for the local families. But remember, the move is yet to find its place in the law. And in a video that is making the rounds on the internet, former Indian cricket team captain MS Dhoni was seen traveling in the economy class of a flight. And what's interesting is that when he was offered dates and chocolates by the cabin crew, he picked up only dates and politely returned the chocolates. The video also shows Dhoni, by the way, playing the very popular tile matching video game Candy Crush on his device. Thanks to the popularity that Dhoni enjoys, Candy Crush was very quickly trending on social media after that. In fact, there are as many as 3.6 million new downloads of the game, by the way, in just 3 hours of Dhoni playing Candy Crush going viral, and this is a statistic that has been acknowledged by the company itself. The official Candy Crush Twitter handle posted a tweet saying that saluting iPad crushers like MS Dhoni.
All right, time to get you the khabar on D Street. We've got Tube Investments today that's in focus as its EV businesses have entered the commercialization phase in the first quarter of this fiscal. Let's take it across to Vinny with all those details. And Vinny, what's the company's investment plan?
Absolutely. So, when you look at it in terms of the EV business, they're entering into the commercialization phase. Q1 FY24 is when this phase has started. It's nearing the end of its capex phase for the EV business. Now, they've already invested 650 crore rupees in the EV business, and they plan to invest around 250 crore more in FY24 and take the products to the market as well. In terms of the electric three-wheeler vehicle, their launches have started in the southern states. For electric commercial vehicles, the production would start in its new plant in Manesar plant, which is in Q1 FY24, and obviously the tractors would be launched in FY24 by the end of FY24. Now, let's not forget the stock has already seen a run-up of more than 90% in the last 1 year. They've met a lot of domestic investors as well in the month of June. So there is a lot of interest that is coming for Tube Investment and management guidance. When you look at it in terms of the commentary that we have gotten from them previously, engineering business, they expect that to grow in double digits. They're expecting a margin expansion, and the metal formed business is also expected to see a 10% overgrowth in the next few years. With this EV business also coming into commercialization phase, new launches coming up and going to be starting by the end of this year is something that will keep interest on Tube Investments.
Okay, and now let's take stock and take a look at why Paytm and Star Health are on Nikuj's radar this morning.
Let's first look at Paytm and Nifty. It's not a like-to-like comparison, but we're trying to establish that how unreal the outperformance in some of the consumer and fintech stocks is. Selective data, but we're looking at the year-to-date change in, let's say, the Nifty and the Paytm stock. Now that's yesterday's Paytm stock. Let's look at the year-to-date move here, and that will just come up, and there you go. Now, Paytm is up 57%, and Nifty this year is up 3%. 57%, 3%. So the rise in Paytm, I guess, has been
from those lows.
From
it's
those
recovered
lows.
9%.
Bombed out levels, I completely agree. But the underperformance in Paytm, or that deep value which had come in Paytm, the contra buyers, I think they've really got what they wanted in terms of a comeback. Now for Paytm, there are two concerns here. I'm not even getting into business, but Jio, Reliance AGM. And ahead of Reliance AGM this time, it may not be green hydrogen, it may be about the new kid on the block, which they would be listing somewhere in FY24, which is Reliance Financial Services. Markets are expecting Reliance or Mukesh Ambani to come out and make some grand announcements about how large they will scale up their financial services. Directly, indirectly, it's going to be a digital-based service, which could have impact on Paytm and the entire fintech space per se. That is something which you need to be aware of. Second, bank investors are not done selling. Especially we know that Alibaba still has 25% stake. Higher the stock price goes, the more chances of them selling. I think it's going to be something which could change the demand-supply dynamics. So the stock is no longer bombed out. The valuations are no longer all that attractive. Real concern which could come out of from Reliance AGM in terms of what the Reliance vision for financial services could be and the overhang of the stock. Net, I think it may not hurt you if you own Paytm to book some profits. And I think in the near term, the stock may just get jammed, largely because some of the concerns I flagged. This entire space has gone through a rough and a tough patch, and that's largely because of the claims they had to give because of COVID. It's in the healthcare business, COVID claims, hospitalization were very high. As a result, this entire space, they had to go through what could be called as a tough period. For Star Health, they've understood that running the corporate business in India is going to be difficult, and they're looking at exiting that business. They are focusing on the retail business. They've got a lot of levers here. The banca and the semi-urban rural market, largely retail. That's work in progress, and that I think what market should recognize. For a minute, let's keep away the whole halo effect that at once upon a time Rakesh Jhunwala invested in it, and Rare still has a large chunky stake there. But if you look at the business independently, the stock has done nothing. This entire insurance space is making a comeback. This is one of the finest companies in the healthcare business, and valuations are looking attractive. I will not be surprised that from here next 6 months, a company like Star Health could actually start outperforming the market. Just like Paytm and Fintech outperformed in the first half of this year, some of the insurance and some of the AMCs and some of the other allied companies may outperform in the second half of this year.
All right, there you have it. That's the editor's take coming in. But moving on, what are the index calls from our charters this morning? The pre-open rates around the 18,700 mark. You've got a buy rating from Kunal, and majority of our technical guests, the other two, believe that it's a whole recommendation on the index. Do remember, bound to be volatile owing to the expiry this week, and the consensus rating on the index seems to be a hold. It was, of course, yesterday the broader markets that took charge. What about the Nifty Bank Index? Well, while Kunal continues to maintain his buy rating here as well, both Naresh as well as Kush believe that it's a hold call on the Nifty Bank Index.
Naresh, we are all waiting for that breakout on the Nifty, which is not happening. At what time you would say that the breakout ain't happening? It's time to look on the other side now.
So once we start breaking 18,600, 500 zones, close below that, that is the time where we say the breakout is not happening. Or say at least few of the heavyweights start breaking down. Say maybe ICICI Bank breaks down below 900, or a HDFC Bank breaks below 1580 levels. Reliance breaking below 2400. At least one of these names start breaking down, or the Nifty starts breaking 18,600, 500 zone on a sustainable basis, maybe at least 1 day of close. Once that happens, that is the time we call the chips off on this rally and then expect a much longer consolidation.
Kunal, I'll pick up the outperformers, and you can choose what the way forward for them is. One is Paytm, second is Indian Hotels, and third is Tata Motors.
I think all three of them are attractive, I would say, even at current levels. So, we look at the trend set up for, these names. So, as I was pointing out earlier, that Paytm has run up exceedingly high. indicators are overbought at 800 plus levels. So there's bound to be a point where the stock would get into a correction. I think we have already seen for one part of the correction playing out for Paytm. I think from 910 approximately is at 840. Which means that a good part of the correction is played out. Maybe another 40-50 points of correction could be in line for the stock price before it settles into a strong trading support range. Tata Motors, on the other hand, I think from 580 approximately, the stock has come back towards 550, 560 mark. Yesterday, the stock managed to see a bounce back like what we saw for most of these auto names. So again, the setup for Tata Motors is very attractive, and even for the likes of Indian hotels, the stock has seen a correction from I think 395 levels. So which means that major part of the correction in the mid cap and the large cap names are starting to play out for themselves. Now, depending on the kind of performance these stocks have shown, you could probably expect a correction. But then whether that could be an opportunity to buy back, I would believe so, yes.
Well, as you walk into trade this morning, there's a big 20-page report which has hit from Kotak Securities in my mailbox, and they're talking about we struggle to find ideas in consumption, investment and outsourcing sectors after the sharp run-up. BFSI is the only sector which offers value. All the even stocks have rallied in the last few days. Kotak is making a bearish case. Well, there's a time in the market you need to be active and go long. There's a time in the market you simply need to hold and do nothing. And there's a time in the market where you need to have an interplay between selective profit booking and raising cash levels. I think we are there where you want to raise some cash. What are the triggers now? July earnings season, expectations are high. FI selling, it has reversed. FI buying has reversed. And globally markets are looking slightly shaky. So I'm not saying that the trend is going to reverse, but like what our channel advice has been that the best part of the summer rally is not behind us and you should not be selling at all. I think now my sense is that the yellow light has started, at least in some of the middle stocks. First rates will just start pouring in on your screen, and there you go, 57 points higher for the Nifty. It was a okay Monday for the Nifty actually. For the Nifty, it's a 51 point start. The market breadth is looking near perfect, and you've got Adani group of stocks, you've got insurance stocks, you've got Coal India, a whole host of stocks which are off to a good start. So what do you want to start with? Well, let's start with a theme which is defense, and then we look at railways. Adani group of stocks, the AGM of Adani Enterprise, they're talking about how the size of the business is going to change. Defense, HAL 36 rupees higher. You've got BL flat at 122, and you've got Mazgaon Shipyard, which in a sense was like the talked about stock yesterday, both in terms of price action, volume action. Can you believe that it's at 1300 now? Just been a one-way ride for Mazgaon Shipyard. And then last but not the least, you want to look at Reliance and then Infosys. But the breadth, I think, is where the real excitement is in terms of the market sector.
Oh yeah, absolutely. In fact, just highlighted Bajaj Auto and IndusInd Bank, especially after that Macquarie note, wherein on IndusInd Bank state that they're confident of increasing their NIMs from the current 4.25% to 4.3% to now 4.4%, although IndusInd Bank is not really seeing any excitement. Let's see what Unilever is up to. Rohit Java takes over as the MD and CEO from today. Unilever as well starts off very, very quiet in trade. Paytm, Macquarie has actually downgraded it to a neutral from the earlier outperform. They maintain their target price though of 800 bucks. 842 is where Paytm is in trade today. AB Capital, the QIP of 1750 crore rupees, floor price 175.99, gets launched today. AB Capital will just come for you on your screens. This was, remember, a big mover in trade yesterday. And then, of course, Sapphire Foods as well, wherein a large trade of 3 million shares is expected in a price range of 13.45 to about 13.91. That's the other stock in focus. And let's see what Parag Milk as well is up to. 6 Cents India, led by Nikhil Vora, has been a buyer. 7.8 shares at 132 rupees per share price point. 135 down tick of 2% on Parag Milk is what you're seeing in trade right now. But yeah, net, once again, a very, very quiet start. Marginally in the green, 18,750 thereabouts. Kunal, where does it go from here?
Yeah, I think it's an okay start for the index. 67 points up for the Nifty. Hopefully that should have a positive effect to the rollovers, which is pending today as well as on Thursday. In terms of the opening stock, the trade which I would look to look out for in the open would be Maruti. I think that's a stock which looks extremely attractive after yesterday's bullish engulfing chart, and the recovery in the in most of the other auto stocks, I think this could be a stock which can see a decent upside even going forward.
Okay, that's Maruti, which is on Kunal's radar. Lots buzzing away within the broader universe as well. Let's find out what Naresh's top recommendation is. Naresh, your first trade?
So that would be another auto name, that Hero MotoCorp. That looks interesting for a structural trend change. So at 2800, 2850 is a good zone to accumulate with a short-term view as well as a medium-term view.